Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. Rate cuts, right? That was then, this is now. And the money and bond markets received their first look at the U.S. employment situation for 2025. And on the surface, the results were somewhat of a mixed bag, right? And I think given the importance the Fed has placed on both the inflation and labor market aspects of their dual mandate, it was prudent to check under the hood of the jobs data and see if anything stood out. And after going through this exercise with the January jobs data, I did discover that the employment numbers may have been not much of a mixed bag after all, but rather another indication that the nation's labor market remains solid. And I think that's a key factor when trying to ascertain the outlook for any potential rate cuts. Now, what I've been focusing on specifically was the 3-month moving average for U.S. total non-farm payroll gains. And I think utilizing this means of an analysis helps to not only smooth out any outsized increases, decreases, things like that, but more importantly, can provide guidance for underlying trends. And here's a few thoughts. And I think that kind of highlights what Powell and company are looking at now as compared to when they began cutting rates in an aggressive way back in mid-September. And if you look at the 3-month moving average increase for payrolls as of January, it's been on a rather noteworthy ascending trend since November. And the current reading is now at its highest level since March of 2023. Now, when the Fed cut rates by 50 basis points back at the September FOMC meeting, the policymakers were operating under the premise that the labor markets may be cooling too much. The 3-month moving average had fallen to only 82,000 in August. Now, the labor market narrative has done a 180 since that first rate cut, and the current 3-month number I just alluded to is plus 237, right? A big difference. Now, Fed rate cut expectations still point towards a June-July timeframe for the next decrease and tilt towards a total of 2 rate cuts. It's more like 1.5 to 2, but we'll say tilts towards 2 for all of this year. But, if the labor market backdrop remains solid, inflation stays bumpy, and policy tariff-related uncertainty continues, which, of course, another week, another announcement on that front, the hurdle for future easing is raised accordingly. And the ascending trend in new job creation doesn't provide the underlying macro support for a continued rally in the 10-year Treasury yield. Remember, it dropped nearly 40 basis points from its January peak. As I'm speaking to you about a week ago, that was the case. In fact, this heightened volatility and renewed pressure to the upside, in our opinion, is the more likely scenario for the 10-year. So with the investment backdrop for fixed income, it's highlighting the value of Treasury floating rate notes. And that's the cornerstone of our active-passive barbell approach, where the emphasis is on income without the volatility. I'm going to end it there. Have a great rest of the week, everybody, and be well.